we at OmniScience like to do scientific analysis, right?
Yeah.
So we have to work on facts in itself that India is one of the fastest growing, or the fastest growing, not one of the fastest growing major economy. Increase, and the forecast is that that will continue happening. That creates a panic situation for someone who's borrowing short term and investing for longer term.
Correct. Correct.
So those traders who are doing this, which is a very small portion of the total FI. FI is about 0.8 trillion or something.
All right. So, what is your view on FIIs, sir? Why are they exiting, and what is the narrative that is there in the market is slightly uh, negative, I would say. So, what is your view?
Yeah. So, I mean, as we shared in the initial conversation itself, that India is one of the fastest growing, or the fastest growing, not one of the fastest growing major economy,
Absolutely.
and nobody else comes anywhere close. Okay. So the narrative that FIs are exiting because economy is not doing well or companies are not doing well, absolutely not true. That can be ruled out based on facts. See, we at OmniScience like to do scientific analysis, right?
Yeah.
So we have to work on facts. And then some people will say the facts are wrong, which again we don't agree, except that the GDP numbers are not correct, and all that is not true. The companies are reporting all those revenue growth, earnings growth, all those things.
Yeah.
See, earnings anyway fluctuate, so let's not get too focused on the earnings. They fluctuate from quarter to quarter, year to year, based on various things, but the revenues are consistently showing increase. As we also discussed, companies are putting capex, etc. So the economic health of the economy as well as the companies are good.
Yeah.
Okay, and that is not the reason for FIs to exit. The most important factor, as we discussed, is the yen carry trade. Okay, because the Bank of Japan started increasing the interest rates, right, and the yen started appreciating. People who used to do the borrowings from yen, etc., and then invest in other places, that's becoming a little bit difficult to maintain,
Absolutely.
right? So, so the and it's not that one or two rate increases are creating the problem. It was a consistent increase, and the forecast is that that will continue happening. That creates a panic situation for someone who's borrowing short term and investing for longer term.
Correct. Correct.
So those traders who are doing this, which is a very small portion of the total FI. FI is about 0.8 trillion or something, and hardly 2, 3, 4% of FIs have exited. So these are the short-term traders who do this kind of thing. They had to unwind. That was number one.
Correct.
Number two, we were anyway at a good profits, right? Over last 3, 4, 5 years, in middle of second half of 2024,
Yeah.
we were giving crazy 3 year, 5 year, 1 year returns,
Correct.
right? So people would like to book in, and of course the valuations were very high. Alternatively, they got opportunity initially in China.
Yeah.
Then they got opportunity, that was the initial play, that it's very undervalued, etc. And then the second part was Korea and Taiwan.
Yeah. Yeah.
Okay, where you had high growth as well as you had access to AI. Okay, so AI had in the US market become popular,
Yeah.
and you could do like cheaper multiples of AI companies in Taiwan and Korea, which were very critical part of the AI value chain.
Correct. 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 Correct.
And so money moved from India being the emerging market to Korea and Taiwan, where you had more AI growth as well as cheaper valuations.
Yeah.
Now all of that is done, and there was third overhang of the US putting huge tariffs on India. It's not that the tariff was going to make much of a difference for the overall economic situation or the market,
Correct.
but it was the sentimental thing that there was a kind of perception that US is going anti-India.
Yeah.
And then if US is going anti-India, then should an FI invest in India? So there'll be some people who would start asking those questions, and that's why they were all waiting on the sidelines.
Correct.
Now that the overhang is gone, it's very clear that US wants to do a deal with India. We have given the framework. Interim deal is in the works. A lot of color has also come out.
Yeah.
So we think all these things have played out.
Hmm.
and FIs should start coming back.
Correct, correct, absolutely. So, so that's a very insightful view, sir. Particularly the divergent dynamic between domestic balance sheet strength and global liquidity cycles. If external capital flows remain volatile and while domestic credit remains resilient, the financing layer becomes central to market sustainability. So now let's explore how that translates into earnings and valuations. So my next question to you is, are markets currently driven more by earnings, delivery, liquidity conditions, or narrative momentum? What do you say?
All three are at play.
Okay.
Okay, right. All three are at play. But I would say liquidity is not driving the markets. Liquidity is whatever is required is there, but it's not that there is excess liquidity or anything like that, or that there is deficiency in liquidity. So liquidity is less important. Sentiments always drive markets, and as Benjamin Graham, the guru of Warren Buffett, used to say,
Hmm.
market is a in the short term is a voting machine, and in the long term it's a weighing machine.
Absolutely.
So short term the narratives are driving,
Yeah.
and then the long term the earnings will drive.
Absolutely.
Okay. A liquidity, of course, does that, but liquidity-wise, domestic liquidity is
Yeah.
neither in excess. I would say it is sufficient. Global liquidity we already discussed. Like as the Fed again starts cutting, and this yen overhang is kind of played out, the money FI money will start flowing back in again.
Correct.
But earnings it is.
Yeah.
Earnings is the long-term focus.
All right. So that is a very crucial point. Narratives may drive short-term price action, but sustained returns ultimately depend on earnings, delivery, and capital discipline. In that context, sectoral leadership must be aligned with structural capital formation. So now let's come to and talk about some sectors, sir. So from a micro perspective, which sectors are structurally positioned to benefit over the next 12 to 24 months?
Yeah, so this would be a combination of high fundamental growth
Hmm.
as well as lower valuations.
Absolutely.
Okay, so there are a lot of other sectors where there would be high fundamental growth, but the valuations are already incorporating that.
Yeah.
So on the stock market or in those stocks, you should not expect too much.
Yeah.
While the sector where the growth is there, even though it might be slightly lower compared to the very popular high growth sectors,
Yeah.
maybe it is medium growth rates,
Hmm.
but the valuations being very cheap, that is going to drive the that is likely to drive the returns.
Okay.
And in that sense, as we already discussed, we think that the overall banking sector,
Hmm.
which is one of the which is the largest weight in Nifty,
Hmm.
35% is already the financial sector in Nifty.
Okay.
So it is the largest sector,
Absolutely.
and it's private banks or public sector banks.
Hmm.
Both are significantly undervalued, in our opinion.
Okay.
Okay,
Yeah.
public sector banks are crazily undervalued. Private sector banks are also significantly undervalued.
Okay.
Given the kind of growth rate we are talking about,
Hmm.
and we've already discussed a little bit that the private sector has started borrowing and investing in capex.
Absolutely.
Government is already doing that. And third segment is the consumer. Okay.
Correct.
So consumer demand for personal loans, housing loan, vehicle loans, etc., etc. That is also the third segment. All are healthy, and overall blended, we think it should be mid double digit kind of growth rates over next 3 to 5 years in terms of credit growth, and that is the kind of that will translate into similar revenue growth for banks, but even higher earnings growth because the costs are fixed.
Yeah.
On the same expenses, they can lend more money.
Yeah.
There is unutilized capacity with banks, so earnings will accelerate. And so that is the first sector.
Okay.
PSU bank, the juiciest, I would say. And okay, this is not a recommendation. We just give sharing our view,
Yeah.
and we have been overweight for 1.5 2 years. So public sector banks and private sector banks.
Yeah.
That is the second because the valuations. Compared to public sector, slightly higher, but compared to what it should be, even in private sector, significantly lower. That is the second one. Third one is housing finance. Okay, underappreciated. Fourth one is power sector. Fifth one is infrastructure, which includes railways and parts of defense, etc. But in railways and defense, you have to be very selective.
Correct, correct, correct.
Okay, in terms of what kind of companies, the valuations, etc. And then there is the power sector
Correct.
and logistics.
Yeah.
So this is, I have given you all the things which we think are strong, and we are overweight naturally in all of these segments.
All right, sir. So that's a nice insight. Your emphasis on financials as the financing engine of structural growth is particularly compelling. If infrastructure, manufacturing, and digital expansion must be funded, then clean bank balance sheets and credit growth becomes transmission channels for the broader vision. So, but no structural stories without risk. So now coming to risk and volatility. So my next question to you, sir, what are the key risks investors must be maybe underestimating in the current environment? Over to you, sir.
So what happens is the biggest thing which I think consumers and lot of market participants also, that we have been chasing the consumption theme for long. And so definitely India is a very much consumer market, and the consumption is been doing well and will continue doing well. The growth will be very high.
Yeah.
The challenge is that there is so much growth in the economy, so many startups. If you especially look at Shark Tank and all that, it's mostly the consumption businesses which come in. Okay, so there are a lot of startups in the consumption side
Yeah.
which are competing with the listed players.
Correct.
So the listed players' growth rate has to, they're losing market share to these new entrants, right? And it's not one or two entrants; it's like hundreds of startups. So each, doing 5 crore, 10 crore, 20 crores, and even a behemoth like Hindustan Lever and all those start getting impacted
Correct.
in terms of that they can't grow at the market rate because they are already the largest market share. So
Correct.
they can only lose the market share. Okay. The second point is the valuations. So the valuations are very high.
Yeah.
Now, all these kind of consumer companies with branded moat companies, which Buffett followers call them,
Yeah.
they became so popular as that if Buffett was in India, he would have bought this, he would have bought that. And they were all taken to 50, 60, 70, even 110 P. And they became so overvalued despite their growth rates being nominal growth rates being 8, 9, 10%. Most of them were below 10%, and some were slightly higher, maybe 12, 13% also.
Okay.
But you took them to that kind of elevated, and now they're down to 50, 60 P,
Yeah.
but still extremely overvalued for the kind of growth rates.
Yeah.
And the mistake investors do is because they think, oh, I want to buy that Buffett like company, the moat company.
Yeah.
And now it is cheaper because last year or year and a half back, 2 years back, it was trading at this price. Now it looks like 30% lower, and consumption is doing well. So why cannot I buy this?
Yeah. Yeah.
But it's still extremely overvalued. So that is one mistake which not just retail investors, this is being done by fund managers as well.
Correct. Correct.
Okay.
Correct.
A second thing which we are very careful of is the IT.
Yeah.
Okay. The business model of IT services will be required in future,
Okay.
no doubt about it. But the current growth rate is very, very low.
Achha.
In the 1.5, 2 years,
Correct.
the growth rates are very, very low, and there is huge risk of AI, disrupting the traditional business model.
Correct. Correct. Correct.
That doesn't mean that everyone will be out of job, etc.
Yeah.
Each guy, if you remember the earlier talk, that each Indian worker is, Chinese worker is 3 times more productive and Japanese is 5 times, etc.
Yeah.
Same way, the AI is going to empower each Indian worker to, okay. So that doesn't mean that everyone else will be out of job. It means that more work will be there,
Yeah,
much more work will come in, and all these people will be producing that. But
absolutely.
that's going to take couple of years.
Correct, correct, correct.
But the valuation of IT is such that it's already paying for that. So that is another caution we would like to give.
Okay. All right, sir. So, so that layered risk framework, global macro energy, capital flows, and execution is extremely useful for investors trying to calibrate exposure. Yet, amid volatility, long-term investing requires an anchor. And so, let me ask you about that anchor. And this is our last question, actually. So, amid daily noise, what should long term investors stay firmly anchored to? Over to you, sir.
So think about it. In 1991, India's GDP was somewhere around 300 billion dollars or so.
Yeah,
Now, 35 years later, we are at nearly touching 5 trillion. Very
absolutely.
soon we'll touch 5 trillion, right? On same way, the markets were also very, very small.
Hmm.
The market cap of Indian stock market was in that same range.
Yeah,
And today it is in the 5 trillion range.
correct. Right.
So if you think about that, the market cap grows in tandem with the economic growth rate. Now anchor yourself to 2035, 10 years from now, let's say.
Hmm.
Roughly, most people expect around $10 trillion economy,
Okay.
right? I mean, and it's not something crazy. We are at 5 trillion roughly today, and a 7%, like rule of 72, if you use,
Yeah,
7% growth takes you to 10 trillion. So
absolutely.
it's not like we are talking of something crazy. Okay. So 7% in dollar terms, nominal dollars. Okay. So we are at 10 trillion nominal dollars.
Okay.
What do you expect the market to be?
Hmm.
Market will be also linked to that. It's slightly more because we are also export driven and will become even more export driven. So it's not just our GDP, it is our GDP plus we are targeting EU GDP, we are targeting US GDP,
Hmm.
and as I mentioned, we might be targeting the Japanese GDP as well.
Correct.
So the what is called a Buffett indicator of market cap to GDP ratio being one as fair value is a very rough thumb rule. But
Correct.
if your GDP itself is exposed to other larger markets,
Yeah.
then we would expect that Indian market cap would be more than 10 trillion. If GDP is 10, it could be 12 trillion. So keep your eyes on that. That I am going from 5 trillion to 12 trillion, or let's say 10 trillion.
Absolutely.
So, is your portfolio going to grow? If you don't do anything stupid or crazy, your portfolio is also going to grow in line,
Correct.
slightly faster or slightly slower.
All right, sir. So, okay, so that's a powerful closing insight to focus on structural capital formation rather than headline noise. So, and this brings us to the close of this insightful leadership conversation. And so, Dr. Gupta, thank you for connecting macro evolution, policy sequencing, and capital allocation with such clarity. Your perspective reinforces an important idea. India's growth narrative is not episodic, it's architecture. All right. So, to our viewers, you can follow Dr. Vikas Gupta and OmniScience Capital on VRIGHT Exchange for structured, transparent, and continuous investor engagement. We remain committed to bringing you credible leadership voices, disciplined thinking, and discovery without noise. Only on VRIGHT Exchange. Thank you. Namaskar. Thank you, sir.
Namaskar.
Thank you.
Pleasure to be here.